Good afternoon, everyone, and welcome to Community at Treasure. Like every afternoon, it's a pleasure for us to be here with all of you. And like every afternoon, we have great content that we're going to be sharing. So we're very excited that all of you are joining us today. Today's content is definitely going to be in our field. That's the field of real estate, where you're going to be able to learn what are some of the great ways in which you could try to buy your first home or any home today. To join me today, we have one of our, let's say, more familiar faces as a co-host. You gotten to know him to be with me in a lot of these shows. So welcome to the show, Alex. It's a pleasure to always have you here.
Hugo, how are you doing? Thank you so much for having me again. I'm very excited about today's content. It's going to be very, very helpful for a lot of people. I know we have a great person today, very professional with a lot of experience that is going to share with us her knowledge, and I'm sure the community is going to benefit from it a lot. So go ahead. Thank you.
Thank you, Alex. As always, we love your remarks, love everything you can share with us. So I'm sure you're going to have, like always, some great questions today that are going to allow everybody, including myself, to learn a lot about our actually visitor today. So to not give her any further wait, let's invite Lily Kondo. Welcome to our show. We're really excited to have you here today. So we'll let you kind of introduce yourself and tell everybody you know a little bit about yourself.
Hi, how you all doing? I'm doing well. I just wanted to share who I am. I have been in the business. I'm Lily Kondo with Envoy Mortage. I've been in the business over 35 years. I started when I was 15. So you can tell how long, how old I am. I've been in the same area in Florida all that time. And I would love to be able to guide you through these tools that we have for home buyers to know what the bank is looking for in a mortgage to give you. So without further ado, can I go ahead, Hugo, and go for the...
Absolutely, Lily. Thank you so much for letting people know a little bit about your background. And definitely you've been in the business for a little bit, but you still look like yesterday, so it's great. And we are going to take a lot of your experience today and learn as much as we can. So I think the first question that we all have is, how could I buy a home today, Lily? What are some of those options?
Well, the first thing you always should do as a buyer, as a prospective buyer, and getting away from rental, is to get pre-approved. And that's how you can own a home, is when you get pre-approved by a lender to let you know what the steps are in getting pre-approved, whether you buy now or 6 months from now. But it helps you to know what the parameters are. And then therefore, after you get pre-approved, then you can go see a realtor and go look at properties that you can qualify for. So one of the first things that I would say that you need, there are 4 guys. They're right there on your screen: in character, capacity, capital, and collateral. Any questions from you, Hugo, or from Alex on character?
Yes, Lily, in that we were talking a little bit a few minutes ago behind the scenes regarding today's market, and how a few things have changed, and that's actually what we wanted to get, that update from you, and how, same thing that Hugo was asking today, specifically today, what does a first-time home buyer or a home buyer would need? And you told us that you have your 4 C's. Your 4 C's. I want you to tell us more about it.
Okay. All right. Let's talk about character. Now, when I say character, they go, what? What is character?
I know, that's a big word. What is character?
A big word. I know it is.
Is anybody even going to be able to buy a home?
So character is about credit. The lenders are always looking to see what you've done in the you have done in the past. One has done in the past, as far as paying the credit cards on time or paying car payments on time. They look at your credit as a startup on how they're going to look at the way you're going to pay the house payment for the next 20, 30 years, or 15, depending on what you're looking for. So they look at history of credit. They do look at 2 minimum credit cards or open lines of credit for about 12 months. Sometimes I can get away with 6. And they like rental checks. If you paid rental, you should pay with a check, because they love to see canceled checks. FPL will send a letter saying that you are always on time on the credit with them. Auto insurance, that would also be a letter that you can get. And these are the ones that I use for alternative credit when I need more credit to beef up the credit of the person, especially first-time home buyer, to help a young credit. That is what credit is all about. Now, there's more to it than that if you want to know more about it. So ask me.
Yeah, Lily, specifically today, tell me, a first-time home buyer, what kind of credit score do they need right now?
Okay. Normally for a conventional loan, which is the 30-year fixed or 20-year fixed, Fannie Mae, they call it conventional, but it's the big guys in the secondary market are Fannie Mae, Freddie Mac, and Ginnie Mae. I call it 2 ladies and a guy in the secondary market. Fannie Mae and Freddie Mac are conventional loans, what we call conventional loans. And Ugo's laughing. And that is 620.
I'm having too much fun already, Lily. That's why. You sold me with the 2 girls and the guy.
So that is your conventional loan, okay? Those 2. And then you have Ginnie Mae. Ginnie Mae does the VA and FHA. Now for conventional loans, you need a middle score of 620. Now middle score. So you could have a lower score and a higher score, but we go the minimum. FHA, you can go down to 580 credit score. Now, most of the ones I've ever done have been over 600, and that's fine. At this moment, we have a higher credit score on FHA, which I know by the time, May or June runs around, it goes back into 580 or 600. But 640 is the middle score for FHA, FVA right now.
Okay, that's very interesting to know right now. Especially, there's a lot of people that right now is wanting to buy their first home, and now that you talk about the character, that's very important to know that credit score to begin with. Then you talk about the capacity, your second C. What is that about?
Well, capacity has to do with employment. And what we're looking for is stable employment. You could have changed employees in the last 2 years, but you're in a similar field for the previous 2 years. We look at 2 years, everything is 2 years. 2 years tax returns, 2 years W-2s. We look at your last 2 years. That's what we look at. Now, if you have changed employers because of whatever, they gave you more raise, but you're in the same field, we're okay. If you have only been working for them less than 3 months for the new employment and you have changed fields, we always have to look over the 3 months probation period that most employers have in the state of Florida. I don't know about another state, but down here it's 3 months probation period. So, but if you're, let's say that you're studying to be an RN and now you have a job as an RN and you don't been there a month and a half, but you have been studying to be an RN, you got your diploma. Guess what? You can go ahead and, as long as they give me a letter saying that you are hired and you're not on probation, I can do the loan. So employment, we also been looking at self-employment. That's something that I always try to help my clients with, is to know that we use your net income on a self-employment, not gross income. So what is net income? Gross minus all the deductions that you legally can have, like car, mileage, all that stuff, cell phones, meetings, dinner. So we look at that and we have average for 2 years. But if you're you are a employee, I only need your last 2 years your last 2 years W-2s, really, not even a tax return, and a couple of pay stubs, and that's it. That's what employment is all about. Mm-hmm.
Lily, something there that especially now being a little bit more of an independent, I know a lot of people ask is like, so what specifically do you look at the bank records? How do you calculate all of that? Do you look at their accounting for their businesses? kind of like, what is it, what are the documents that you will look into?
For self-employed persons or commission like us, we look at the last 2 years tax returns. We look at if it's self-employment, Schedule C, which has an income, and then you have expenses. Now, we can add back, listen to this, guy, we can add back mileage. If it's business mileage, we go by 26 cents a mile, and we can add back depreciation, which is just a paper depreciation, nothing else. So we can do that. But then we take the last 2 years net income, adding those two items back if we have them, and then we divide it by 24 months. And that's we come up with an income. So it's an average income for self-employed people or commission, 1099, you know. I'm an employee of Envoy. I get taxes taken out. I look at my income like, all the money taken out of my employment, but I am on commission 100%. So if I went to buy a house next week, I would have to show 2 years income. And I can, you know, in my case, I wouldn't be able to use any unreimbursed employee expense because they usually pay for it and I cannot do it anymore. I cannot deduct my own expenses. So, but some people can still.
Lily, I have so many things in my head right now about that topic of the income and the capacity. The first thing I have is in this specific scenario, under the situation we're living, if I was laid off, but I know they're gonna rehire me in a couple months, of course you're not gonna give me a loan right now, but when I get my job back, is the bank, are you guys gonna consider that laid off period something bad, or you gonna work with me?
No, we will not do that. We will take the fact that you were laid off because of the pandemic, this COVID-19, and then we will ask you to at least show one pay stub, and maybe ask the employer to give a little letter that you have been hired and that you have been a good employee, and that's it. And then we can use that income. Yeah.
Perfect. I think that's very important to know. Now, you were talking also about changing jobs versus changing, let's say, industries. So if I am a farmer and then I go into engineering or medical, how is that going to affect me?
Okay, if you are a farmer, let's just say you had a farmer and you decided to become, you know, if you went to school and became an engineer, and while you were going to school, you were a farmer or you were a plumber, you know, just to get the money onto the house, we will take that. We will not wait for 3 months. We will take a letter from your employer saying that you are hired and you have no probation period. And because you studied in what you're doing now, right? We would take that as a new career, and that's fine because you went to school, and we will ask you for transcripts. That's how much we do. We ask you for transcripts and your diploma or whatever, you know, to show that. However, if you were a plumber and now you become a salesperson in the car sales, that's another story, because car sales are 100% commission. They're not per hour normally. So that's going to take 2 years to be able to buy, because you are now not an employee. You're now not self-employed, but you're on commission 100%.
I see. And that tells me one more thing, that is every case is unique. Every
Yes.
scenario is a totally different thing. So it's good to get to talk to somebody like you so we can know exactly how to approach it. And that takes me to my last question regarding this matter is, you mentioned that self-employed, you will take the net income, right? Not the gross.
That's
so
right.
In this case, as I am a self-employed, and in order to reduce my tax liability, I always see what kind of deductions can I get. So if I am going to buy a house and I am a self-employed, then I need to prepare, right? Would you say that 1 year, 2 years before I meet with a lender like you, so I can get some tips on what should be my income on my income tax, so I can be prepared and don't last minute it becomes a problem?
Yes, that's definite. Alex, one of the things that I always do with my clients, especially at the beginning of this year. Now this year might be different because some people have not done 2019 yet. We have to July 15th, And by the way, I went to the last minute to even do them. I always get extensions. So, but normally after that, I tell my self-employed people, like in November, December, let's say last year, I said to them, before you do your taxes for the last year, come and see me. Bring me your year past. Let me see what we can do so you can qualify for a home. You might have to pay a little bit more tax to Uncle Sam, but at the same time, now you're buying your home and you don't have to wait another year to do so. So I try to help them as much as I can. I'm not an accountant, but sometimes I even get a hold of their accountant and talk to them about it. And they love it. They love to talk to me, their accountants. Mm-hmm.
It totally makes sense. And that's one of the things that I recommend. For example, in January and February, I have a few clients that they haven't done their taxes yet, and they are wanting to buy a house. And I told them before doing your taxes, meet with a lender so they can guide you on what you need to do and present those taxes in a way that they're helpful for you in the buying process. So that's very important information. Hugo, do you have the slide of the 4 C's?
Yes, let me put it right back. I was actually getting ready to talk about the other two because I think the other two are a little bit related. But if you have a question, Alex, go ahead.
No, I was just wanting to go to the other two, but I know you have something about it.
No, I was actually, when I looked at it, Lily, and I think we were talking a little bit about, behind the scenes on this. It's when I look at capital and collateral, which are the last two, I kind of think both of them are related. It's kind of like I can't see one without the other. So I would love for you to kind of like give us perspective on that. What do you think? Do you think they're a little bit separate, or they're like I said, related?
They're pretty much related. Capital means savings. I'm always looking for the last 2 months cash bank statements, all pages, and we cannot have a lot of deposits that are cash into the accounts. One of what the lenders are looking for that people just don't save money at home under a mattress or in a safe deposit box, and then they go in and deposit $2,000 cash. They don't like that. Because of the fears that we had in the past of money laundering. So, and I know $2,000, there's some stories I can tell you about that. So gifts are okay. They need to be sourced. They need to follow a trail. And 401k loans are fine because that will count that as a debt against your income. Insurance settlement is fine. And also, we've had, and we don't have it right now, but we've had 5 different down payment assistance loans, and we're going to get them again. I know we are. Within a month or 2, we're going to have them again. 5 different ones that help you with a down payment.
Yeah, no, I know those assistance loans right now, like you said, like a lot of those programs right now, they're kind of trying to figure out how are they going to be reshaped with everything we're seeing. But one question I had though, that I know a lot of people kind of like think about is when you said about the cash, the gifts, how much are people allowed to have as gifts? And let's say, how many gifts can they have?
They can have as many as they want to. FHA says that all the money, these are the differences between FHA and conventional, okay? FHA and be more flexible in this area. All the money that you come in with, all of it can be a gift, FHA, VA, veterans or FHA buyers, all of it can be a gift from a family member or, someone that they're close to, a significant other, Then on a conventional loan, which is a Fannie Mae, Freddie Mac, they would like for you to have 3% of your own money into it, but everything else can be a gift. So that's the difference between them. Cash, we have to source it from their account to the buyer's account. It has to show that it was in their bank and not deposited 2 days before, but had it in there for a while. And they would have to have either a wire transfer or a personal check into the buyer's account. I'm going to tell you something really quick. One of the things that I like, and I like to always tell my clients, if they're waitresses or waiters, they work in the hairstylist salon or facials or whatever, And they're not really the owners, they just work there. If they get tips and it's cash tips, they should put it in the bank every week. They should not take it home and wait till you have $1,000 in tips and go to the bank. But if they see a pattern, that's what the bank, by the way, that's what the underwriters look for in the bank statements. They look at patterns of deposits due every week. I have a client who works for a big company, boat company, but he also works size on a Saturday. He does side jobs, but he always puts in the money every week. I've seen 400, 500, 300 every week. And that's what the underwriter is for, a pattern of your deposits. If you do have cash deposits. Does that answer your question?
Yeah, no, it does. And I think you answer where I know a lot of our customers think about, which especially a lot of them are tip customers. And or once again, they have one job, like you mentioned, where it's a natural paycheck. And you can kind of see the history of that through their bank account. But they also have, let's say, another job where they do cash, or whatever it is, they have that cash and they put it to the side. Sometimes, like you said, they're not depositing. So right. It's just a matter of like teaching them, like, hey, as long as you're doing that pattern of deposits, they can see that there is that pattern, and that ultimately it's all coming from, let's say, that secondary job with the tips and all.
I even had, just so you know, Hugo, I even had a client who owned an electrical company. And sometimes he would get cash and sometimes he would get checks. He owned the company. So sometimes they wrote a check to his company, sometimes they gave him checks. It was cash, it was a small, coming to the house, like they come here and fix my electrical. And so he deposited the money and he deposited every week. And my underwriting didn't have any problem with that. They said, okay, yeah. And I wrote a little note to the underwriter, hey, he's getting this cash, but it's, from personal.
Yeah, I think kind of like what you mentioned a few minutes ago, it has to just be sort of like traceable. You kind of have to have a history or a pattern.
Right.
And, whether it's a gift or whatever, they just have to be able to say where the gift came from and all of that. But that's a really key question, which I know a lot of people, when they're buying a home, they're like, oh yeah, I have some cash, but how do we make it work?
One more thing about that. If you do have cash, let it mature like a banana. Okay?
What do you mean?
I hope my manager doesn't listen to this. But let it mature in the bank. We only look at last 2 months.
Yeah,
I think the last 2 months. So
I think Alex got confused.
Alex.
Lily, I understand now. I understand your tip. Hey, Lily, now that we're talking about this cash, I was gonna leave the questions for last, but I have a question from Carlos right now that says, if I get a gift and I deposit it into my account, how is that gonna be considered? Is it gonna be good? Is it gonna be bad?
It's gonna be good as long as we can trace it back. Source of funds, and we can trace it back to the person who gave the money to him, a check or a wire transfer, or even the cashier check, but we have to see the money that came out of the bank of the person, that it wasn't cash at home.
So if Carlos deposit the gift cash, it's not going to work. It has to be traceable, a check or a cashier's check or something.
That's right. Or you have to let it be like a banana, let it get ripe.
Got it. Okay. I have another question here, and well, okay, I asked you about the gifts. How about the interest rates right now, Lily? What can you tell us about interest rates? I've seen the rates changing almost every day. There's a lot of volatility, and what can you tell us about rates for 15-year loan and for 30 years loan?
Well, the rates have been like a roller coaster in the last 3 weeks, especially the first week of April. Yeah. What, in April, May? Yeah. In April, the first week of April was bad. It was a roller coaster. It has gotten a little bit better. I would think the interest rate, and don't quote me on it because it might be tomorrow differently, but hopefully tomorrow will be better. But I would say about 3 to 3.25, 15-year loan. And then a conventional, will be like 3.5, 3 3/4, 30-year fixed. They're both fixed loans, okay? Income and FHA will be about the same way. Conventional are usually a little higher than FHA, but you know, you're looking at the 3s and the 4s. The 4, about 4, maybe, you know, depending on their credit score and how much they're borrowing. They go by many things, but one of them is credit score and then how much they're borrowing. The higher the mortgage amount is, the better rate you're gonna get.
Got it. I understand. Okay, and I have another question from another of our visitors here, and it's regarding the PMI. This person says, I wanted to wait until I save 20% so I can avoid the PMI, and I want you to explain us what the PMI is. And do you recommend to wait, or should I just move on right now, and why?
I would recommend that, first of all, this time right now, May and June would be a great time to buy a home because the rates are lower, you know, compared to the market that I had history, and there's going to be less competition in the market because, like you said, some people unfortunately, you know, don't have a job yet, back to the job yet. The reason someone should not wait to amass to save 20% is because in a conventional loan, I'm not talking about FHA, FHA is different, but a conventional loan with 3% down, because I do have two different 3% down, Fannie Mae and Freddie Mac. With 3% down, they get the loan right away. PMI, within 2 years, they can get it out. How? The home goes up in price. They can prepay any money they want to the principal anytime. There's no prepayment penalty. And in 2 years, that home will be worth a lot more than what they bought it for, because that's the idea. Even if it went up, let's say 6%, it's not going to go like they used to, like crazy. It's going to be 6 to 10% a year. That's the normal of the, you know, going up. But in 2 years from now, that they have an 80% mortgage compared to the sales price at that time, the value, you know, the appraised value. And now they can call the bank and say, excuse me, my home is worth, and by the way, they should call their realtor, and also check Zillow, because an appraisal is an opinion of value. But they can call the bank and ask, listen, I don't have, I bought my house 2 years ago, and my home now is worth a lot more than what I bought it for. And I only owe, I think, about 8%. I consulted with my realtor and I looked at Zillow, and they both said that, you know, that's approximately what it should be without refinancing. And this is the best part. Without refinancing, they can ask the bank to send an appraisal out. Who pays for the appraisal? The consumer does. But when the appraisal comes out to the property, if they concur that the property is what it's worth, the value, guess what? The bank will take the PMI out and they don't have to refinance. Now, if they keep on renting for the next 6 months to a year to save $20,000 and they pay $1,800, we looked at it behind the scenes, we looked at those numbers. How much was it? Like 10,000 in 6 months? 10,800 in 6 months. That they will never see again.
Let me interrupt you right there. Let's make this very, very simple.
Okay.
Let's go with a $300,000 mortgage.
Mm-hmm.
Let's give an example of how much will be the monthly PMI.
Okay.
So we can, do you have a calculator there?
Yeah, I don't have my calculator. I have my phone calculator. Let me see. Hold on. But I can do it. Oh, okay.
I just want to compare if somebody is thinking about saving on the PMI versus saving on a rate.
300,000 mortgage amount now, that's sales price, 300,000, depending again on their credit. See, that's the thing.
Let's say 750 credit.
They should be, let's see, put 3% down. That's another thing. You know, 10% down would be less, 5% down. But if you did it just with 3% down or 5% down, it would be, I'm trying to remember what the number would be. It would be 0.80, let's say it's 0.85. 0.85. So take 300,000 times 0.85.
And just to clarify, the PMI is the property mortgage insurance, right?
Yes, mortgage insurance premium, or in FHA, and a conventional is private mortgage insurance, nothing to do with the homeowner's insurance, okay?
Okay.
So let's 300,000 times 0.85, I'm gonna use that number, divided by 12. In a house that big will be about $200 a month.
$200 a month. Okay, perfect.
In a price that high in the mortgage, yeah.
Now, if somebody is locked down with what is something realistic, a 3.2, 3.3 interest rate? Is that realistic?
Right, that's realistic.
Today versus, let's say, in 6 months that eventually things are more stable, potentially rates could be, let's say, a quarter to a half point higher. Is does that make sense?
That's an idea, yeah. But
okay. So can you tell me an idea of, let's say, half a point in 30 years, locking the rate down today versus in 6 months? That half a point, how much is gonna, I think I'm putting you in trouble right now.
Because
we didn't prepare you for this. Alex was going to quiz you. He didn't tell me, I swear.
I'm a numbers guy, and I understand a lot better with numbers.
I know Alex pretty well. He's a numbers guy, but I wasn't ready for it. I do have a.
He's crushing them right now.
I'm looking for it right now, but I do have a thing that shows me that. But I don't know where I have it right now. Like a different payments, you know. But I don't know if I have it here in my phone. I'm gonna have to pass on that because I don't remember what it is, and I don't want to give you a bad, not a nice answer, not a correct answer. Let's put it that way.
Got it. What I just wanted to prove there is that the savings of not paying PMI versus locking out a much better rate today are way bigger, you know.
Well, one of the things that you have to understand is not only, let's say I'm paying $200 in PMI, but now I own my house. And now at the end of the year, I cannot deduct that from my taxes, but I can deduct every penny I pay in interest and every penny I pay in property payment, the taxes on the property, which I didn't have before. So guess what? The $200 may not mean anything because now I'm getting all these other write-ups I didn't have before to pay less to the IRS. So, and I'm having my house and I can do things to my house, and when you're renting, you can't. Oh, you can't do this, you can't do that. The landlord tells you what to do or what not to do.
So if I'm renting a house, I cannot deduct anything?
No, nothing. In fact, just so you know, I always give an advice to my clients, and I'm not an attorney, but I give an advice to my clients that they should own another property as an investment. The home they're buying now may become an investment later. Guess what? With an investment, you can do depreciation. You cannot do depreciation on your own house. And depreciation is only paper, just paper. And anything you do to the house that you have rented out is tax deductible too. So I always advise my clients to have not just their home where they own, but always think of maybe buying this one for now, not maybe for my forever home, and then renting it out. And now I have an investment. I buy another home with 5% down. If you qualify, if you show me a lease, I can erase that payment with a lease. So the house, you're not paying anything for the house because the lease is there and the person is giving you money for the rental.
It doesn't become another. Let's say, it doesn't become part, like it won't take away from your income basically.
It doesn't take away from that. That's right. It doesn't take.
It doesn't become a cost. Yeah, it doesn't become a cost. It pays itself. So at the end of the day, you can write it off.
Right.
And ultimately, my income still will be towards the new home that
that's
we're
right. Amen.
Yeah, that's really the goal. I don't think it's ultimately something that a lot of people don't want to do. It's just a matter of like getting there, right? And that's the beauty of it. Like if you buy a nice home initially and you got a good price, good rate, then eventually you can upgrade. And that other home becomes, like you said, it becomes the second place, and you can rent it out, and it kind of pays itself. So a lot of times what you get for rent pays everything, and even sometimes a little bit more. So it leaves you residual income.
Yeah.
Go ahead, Alex.
Now that Lily, now that you mentioned the investment option, do you have any kind of loans right now for investors going on?
Oh yeah, 20% down, always. Why not? Fixed rate, 20% down. It would be a little higher than the regular conventional loan. I mean, than the regular owner-occupied properties, but 20% down, that's all you need. You can do a second home. You can have somebody come up from up north. I am investigating, because it used to be 10% down for second homes. I need to get a hold of my smart desk. I have a smart desk, like underwriters, but they're smart. I call them smarties. And I want to find out if they are accepting 10% down second home, like if you live up north, or listen to this, you can be here and buy in Miami a second home because it's over 50 miles. Or you can buy a house in Orlando and call it a second home. Now, if it's a second home, of course, you have to qualify for the payment, but you can come in with 10% down. It used to be that way. It has changed in the last years, but I think we're coming back to the 10% instead of 20%. But yeah.
That's very good to know, Lily. I have a question from Jose. Jose is saying, is it a good time to refinance right now?
Yes, it is. It's depending on your interest rate and what you want to do with refinancing. I always counsel my clients that I would give them that if it makes sense, we should do it. Now, it makes sense if you're getting money out, that's called cash out refi, because you want to do some improvement to the home, or you're paying 5% interest or higher. You can get a refi, rate and term, which means no cash out, but you're lowering your payment. And if you have an FHA loan, guess what? You can take away that FHA mortgage insurance premium. It will save you money. So these are the reasons you would refinance for it. And I usually sit down with them and counsel them to see if it makes sense. Of course, if they want to take a few credit cards and pay them off with the refinancing, we can do that too.
Lily, does that consultation, because I think that's what stops a lot of people sometimes, does that consultation has a cost? Like when you just look into the papers and see, do they even have an option?
No, there's no cost. That's part of my education. I call myself an educator. My mom was a teacher and my grandmama was a teacher. So I'm an educator. And yes, of course, I'm 100% commission. I'd love to close your loan, but I want to make sure that you give me more business in the future because you've been advised the proper way. Right now, I'm usually doing everything. In fact, I'm going to spend a whole day on Saturday printing paperwork in my office, not here, in my office, because I have one guy that's bringing me some paperwork. He's going to have like social distance and last 2 years tax returns, is self-employed. And then I have 2 other people that are refinancing that I actually have to bring their paperwork because I want to put it in my hands and feel them and, really analyze if they can refinance or they can buy another home.
Lily, I have a question in terms of refinancing that Alex has asked, but some people also, let's say, have equity when they're refinancing. I heard there's an option as well, like you can get some money, like some loan or anything, like if you're looking to remodel or do anything when you do that.
It's called cash out refi.
How does that work?
How
does that work?
At closing, you will get your money. We don't have to, you can go out after closing, you get, let's say you decided to take $20,000 because you need some work around the house. All we do is you have to qualify for the mortgage with that $20,000 added to your payment. And then at closing, you will get $20,000 and you do whatever you want to do with that money.
Gotcha. And that gets added to the total payment you pay. So it's not like you have.
You will get a new mortgage. You will get a new mortgage.
Exactly. You get a total new mortgage, but it's not like you have 2 mortgages now, correct?
No, that's something else. That's called HELOC or home equity loan. And I call that a double SSOR with a home equity loan.
Yeah.
It's usually adjustable, not variable, not fixed. And people don't realize that it's amortized over 30 and they start making all the interest payments. So in 10 years from now, they're still going to owe the principal because they forgot about paying off the principal. So.
And correct me if I'm wrong, but the way it may work, again, it's all numbers, so every case will be very different. But it may work in a favor where, like, if you refinance and let's say you get a better interest, right? And you're also taking the loan, you may be still paying close to what you're paying right now, because of the change. Let's say the subtraction plus the addition brought you back to flat. So that's a possibility. And then you get the money to do any of the remodeling you want to do in your home and upgrade it, especially now that things are a little bit quieter, you get that money to do something at home, correct?
That's what it is. You are right, Hugo. That's how it works. That's how it works. And even I just had a refinance. The gentleman works in the sugar refinery, and he bought FHA, even just to get away from the FHA and get a better interest rate. And he refinanced. His payments were like $80 less than he was paying. He went from a 30 to a 20-year loan. So he saved himself, I think he only had it for 3 years. So he saved himself a lot of years on the interest, and he got a 20-year loan. By the time he, becomes, retire, the house will be paid for. And his payments are $80 less because we saved the money from the FHA insurance too. So there's a lot of reasons we do refi.
Lily, something that I gotta say, and I want to acknowledge you for this, because we have done business in the past quite a few times, and I value so much what you do, because we have sat down a few times and you have told me, yes, let's do it. And a few times you have also told me, nope, the numbers don't add up, don't do it. So I really appreciate that, because that says a lot about you and the kind of professional that you are. So it's very important that everybody that is planning on buying a home sits down with a professional like you that can tell them the truth, just how it is, not making it better, not making it worse. And make sure that they're giving us the right information is so important. So I wanted to acknowledge you for that. Thank you so much for that. And having said that, I have another question from the audience, and that is, when should I start preparing if I want to buy my new house, my first home?
Right away.
Like if I'm, let me rephrase it, because it's a little bit of but the question is not very clear. Like if he wants, let's say the person wants to buy in June, how far in advance they need to get ready with income, with credit, so they have enough time to get everything ready, income taxes, all that kind of stuff. I think that's what it refers to.
Yes. Oh, I understand. Okay. If it's in June and we're almost in May, they gotta start doing it right away, because once I have I have the person pre-approved, and I do a pre-approval, not pre-qual. I look at everything. Once I have them pre-approved, then I hand it over to your realtors to show them properties. It might take them a few weeks to find the home of their dreams, and then we have to close within 45 days, the most. Normally 30 to 45 days is the number. So yeah, if it's June, the end of June, gosh, we're almost there, really, when you think about it. Tomorrow is May 1st. If they have a lease and the lease expires July, I had clients that had a lease, and they decided to forego the last month of the lease just to get the best buy on the property. So if they have a lease, let's say the end of July, you still want to at least get pre-approved to see what you can qualify for and get your feet wet. Even if you don't close till the end of June, let's say, or July, or the beginning of July. Does that answer the question?
Yes, definitely.
Yeah, and I think, Lily, the biggest point as well with what Alex asked is the fact that, like you said at the beginning, there is never soon enough. I think customers should start looking into as soon as they think, because it's not until they speak to the lender that they really know what they can do. And you really set up, okay, whether it's a year plan or so a few months out.
That's right. That's my goal, is for people to get away from renting and buy a home, whether they do it in 3 months, 6 months, or a year. They now know what they need to do to get there. And I will have them again. I've had clients call me a year later, Lily, I'm ready. I'm like, what? I'm ready. Oh my gosh, great. I took her of my husband's. I had one. I met her when I was getting my nails, my feet done, pedicure. She was a Kondo.
The truth being said is that, and I tell a lot of the customers, they're like, oh, I think I'm 3 months out, I'm on a year out. I'm like, okay, that's where you think. Again, that word is key. I think I am, but do you know where you really are? And that, I think, doesn't really come until they speak to a lender. Well, I shouldn't say I think. I know it doesn't really come until I speak to a lender, because the lender is going to tell me, you know what, we need to take care of this, we need to take care of that, we need to have this much money to put down. You're probably going to get a loan in between this amount of money. If you really are looking, because let's say we all want to buy, right, the house of our dreams, and sometimes we're a little bit out of budget, and it's not until that moment that we realize, okay, how much is that going to cost me monthly? Do I maybe need to look for something lower? Or if I'm going to still look in that price range, how much more money do I need? And those are all questions that, until they get to the lender, they're really not going to know. Until they get to you, you're going to be able to break all of that down for them.
Definitely. You have the right answer. That's it. Yes. That's what I always let them know that. Now, let me ask you guys, do you have any questions on collateral?
What collateral?
Collateral.
Oh yeah, I know. We spoke about capital. I was telling Alex, like, do we even talk about collateral? I think we missed collateral.
Well, I want to tell you really quick collateral is, and that's the one I don't have any control over. Neither do you. Well, you do to a certain extent as a realtor, okay? The appraiser is an opinion of value. So it's an educated opinion of value, but it's still an opinion of an appraisal, and really can't change their mind sometimes when they come up with an appraisal. One of the things that I always ask the realtors like you all, like we work with together, is that, I don't know, when I was a realtor back in 78 to 85, was a realtor, whether I was a listing agent or a selling agent, I would meet with the appraiser and I would bring some comparables. Now, that doesn't mean the appraiser going to take those comparables, but at least, you know, you have met with the appraiser and, you know, you brought some comparables that, so they can back you up as far as the contract is concerned. So yeah, that's one of the things that I don't have any, none of us have control over it, except, you know, to meet the appraiser at the house when the appraiser goes down. That's not the buyer's, you know, it's the realtor's job.
Definitely. I have a question from Gabriel from the audience, and his question, not so much from the point of buying a home, but he already has a home. Mm-hmm. And his question is more like, he was told by a friend, which again, we're always told by a friend or an uncle or the neighbor, right, that he could pay his, you know, his mortgage, instead of paying it, let's say once a month, let's say it's a $2,000 mortgage, he could do break down the payment in half and pay twice a month, and he will be done with his payment sooner. Is that truth, or?
That's correct. Let me tell you how to do it though.
Like one of those friend mythologies.
Yeah, no, this is good. I always tell my clients too when I go to closing, besides there are two things you can do. One of them is to, once you make your first payment, especially after you make your first payment, then you can call the bank or the lender, and ask them if they can push on it every 2 weeks, the debit. And they will debit your account every 2 weeks, which will mean that you make 26 payments a year. So if you make 26 payments a year, you can pay that 30-year loan in about 22, 23. That's one way of doing it. But remember, if you're on commission or self-employment, just remember that's going to come through your bank account every 2 weeks, no matter what. And there's no money there, it's a problem. Okay, that's one way. The other way, I tell my clients both ways. The other way is to don't wait for the income tax return to put money into the principal. Take the payment, including the tax and insurance, who cares? The whole thing, divided by 12 months. And every month, when you make your payment, you add principal. You round it up and you add the principal, whatever the difference is. And that's also going to take you to 22 years on that payment. In 22 years, you'll pay it off. But instead of waiting till the IRS, till you get your tax return, something can happen. The car breaks down, whatever. Now you have a budget. Now you know that your payment is not $1,700, it's $1,800, because the other $100 I'm going to put into principal. And you let your lender know that, or you don't have to. If you're paying checks, you're paying debit. I mean, like once a month, direct withdrawal, you can just pay it. Give you the option to always have a payment of the principal only. Does that answer your question?
Yeah, no, absolutely. So there's two options, but just to clarify, because I'm sure people are still thinking about it, you're not paying your mortgage twice a month. You're saying you're paying the same amount. You just break it down into half, and you pay one, let's say in the first 15 days of the month, and the other one at the end of the month. Correct?
Right.
Okay.
Correct.
Yeah. Perfect.
And by that way, see, there are 52 weeks in a year.
Yeah.
So you're not paying 24 payments. You're paying 26 payments.
Which is why you end up paying in 22 years.
That's right.
30.
You're paying an extra month a year.
Yeah, because technically, doing it that way, also you're putting more money towards capital, so you're making the payment quicker, right? But it's a great option that a lot of people don't look into, because if you think about it, it's not like you're having to do more payments. You're basically breaking your same payment, but you're breaking it into, ultimately, you're splitting it up. Like you said, what you have to be very careful with is with making sure the money's there when they're charging you, because otherwise then you're defaulting.
Right.
Perfect.
Correct.
Alex, I don't know if you have any other questions from today, this crowd. Anything else that came up? Alex, you're on mute. We have you on mute.
Sorry, guys. I don't have any more questions from the audience, but I have one question that is in my head right now, and is, how do you compare? Let's think about this moment, and how do you compare interest rate today versus buying at today's prices versus a potential lower price? And I'm asking this because I have a lot of people that is asking me, Alex, should I buy now that there's an interest rate, or should I wait if the property prices go a little bit lower?
Let me answer that. First of all, we're not in 2007, 2008, and 2009, where the prices went completely low. We are in a situation within 2 or 3 months, we would be back in normal. So yes, the prices, I noticed in January, February, they plateau. They were not going up as they used to. They stayed pretty even. But I don't see why or how it's going to go down again, because we don't have the situation we had back then. There was a lot of fraud going on. People had short sales, foreclosures. I don't see that happening because the government has stepped in and is giving people money, helping them out that way. There's going to be deferred payments for some of the buyers, because they can call their bank and get a deferred payment, or for what do you call it? What is the name?
Forbearance.
Forbearance, right. So I don't see where we're going to have the same problem we had back then. I mean, anybody's guess. My educated guess is that we're going to have a very stable price. It might go down a few dollars because some of them were overpriced to begin with. But it's not going to make that much difference if the interest rates go up. Then what are you doing? You're, like, if I wanted to sell my house here in Laxahashi and I'm getting $390, oh, that's great. But then I'm going to sell it for $380. But guess what? I'm going to buy another house and it's going to cost me less. So it depends what you're looking at. It depends how motivated the seller is in selling. That's why I'm saying the next 2 months, those motivated sellers will be the ones to not only help out a little better on the sales price, but also very important for first-time home buyers, because right now we don't have those 5 down payment assistance. And even when we have them, very important, the sellers are going to be more willing to help out with closing costs, to do a concession up to 3% towards the closing cost of the buyer. So therefore, the buyer will have to come in with less money out of their pocket. And that's where I see the trend going. I even saw it in January, February already. That's where the sellers were more negotiable in that sense. Does that answer your question?
Yes, Lily. Thank you so much. That's very important to know. With that said, I don't have any other questions. I wanted to thank you so much for your time and your knowledge. It's been an honor to be sharing this screen with you. Thank you so much as always, big friend. We know each other for so long, so hope to see you soon. And I'll pass it on to Hugo.
All right.
Thank you, Alex. Well, Lily,
Thank you, Alex, for your confidence, and it's been an honor to be part of your family for, I would say, 25 years.
Yep.
At least, Bernardo.
That's good, Lily. You really invest into things. Then think about like the commitment you have in so many. No, but I just want to say and extend back to what Alex said. It was a pleasure having you here today. I think not only Alex and myself learned so much today, but so many of our followers were able to answer many questions. We're able to have fun because I don't think there was a dull moment with you here today. It was so many fun moments, so many moments where we had an opportunity to laugh and have fun. And I love your energy, so keep it up. I'll leave it and put it back to you to kind of like give us some final words, some final thoughts, and then we'll say goodbye to our viewers in a second.
All right. Sounds good, Hugo, and sounds good, Alex. Thank you so much for both of you to have invited me and to have invited Envoy to be part of your team this afternoon. Just wanted to thank everyone that's been listening and seeing this on Facebook. And I want to give you you reap what you sow. So if you sow good stuff, you will reap good stuff. And so that's my logo. You reap what you sow. And I have a lot of clients that come back to me 20 years later because that's what happened. And I always want to do my best to be an influencer, to get people to do the right thing. That's the key, to do the right thing. So thank you so much this afternoon for having me, and God bless you all, and keep healthy. And this too shall pass. This too shall pass.
Absolutely. Absolutely. I truly trust those words. And this is momentary. We're going through this, but we're eventually all going to get through it. And, there's a bright future ahead of all of us. But Lily, at the end of the day, we all hope to have your energy, to have your enthusiasm, your knowledge, and everything you brought to everybody today. We appreciate you once again so much for everything you do. And like you said, because you build not a customer for one time, but you build customers for life. And that's super important in every business. And here at Treasure Property, that's what we're trying to do, is to bring you and everybody who follows us great content, great people like Lily, who can, inspire all of us and not only bring us information, but bring us that great vibe, that great energy. We're here to make sure that we can answer the questions that you, our community, have, to make sure that we can support you. So for those of you who got to the show a little bit late, and we're really happy to get to Lily and kind of hear some of the great things that she had to say, but we're standing away because you didn't get to see it all. Don't worry. On our Facebook channel, you're going to be able to watch the show again as many times as you would like. If there were key moments that were important for you, because that's kind of like the information that was queued, go ahead and you can advance the video to that moment. We also have our YouTube channel at Treasure Property Group. So make sure that you can also follow us there. And for future shows, remember, we're going to continue being here every day of the week. And we'll have another great show for you tomorrow, 4 p.m. It's going to be the time. Remember, we do shows in English and Spanish because we have great customers that speak both languages. So we try to bring fantastic content to both of you. So for everyone, God bless. You have a lovely evening, and we'll see you again tomorrow. We're going to leave Lily's information there in the screen for a little bit so you can see it. Lily, Alex, take care. God bless everybody. Have a good night.
Thank you.
Take care. Bye.